All right, good afternoon, everyone. Thanks for joining us today. Let's wait another minute for the rest of the participants to stream in. Thanks. All right, good afternoon, everyone. Thanks for joining us today for Keppel Pacific Oaks, US REITs guest presentation, or also known as CORE for short. Yeah, so today we have the management from CORE with us. So from the management team, we have the CEO, Mr. David Snyder, CFO, Mr. Andy Gui, the head of asset management and of Pacific Oak Capital Advisors, Mr. Jeff Rader, the finance manager, Miss C. Eiling, and from the investor relations team, we have Miss Brenda Hill. Yeah, so just some quick housekeeping rules. Before we begin, there's a Q&A tab at the bottom. So if you have any questions, please feel free to just drop any questions in the Q&A tab, and the management will get to those questions after their presentation. Yeah, so without any further delay, let's head right into it. I'll pass over the time to Mr. David for the presentation. David, please. Thanks.
Hi everyone, good afternoon. This is Andy here. I'll start off the presentation. No worries. With a quick intro on CORE. So you can see on slide 4 that CORE is essentially a US office REIT with a focus on the key growth markets, which is significantly driven by tech, innovation, and we are mainly located in the Super Sun Belt or 18-hour cities, and we offer the investors an opportunity to benefit from solid US office real estate fundamentals without being subject to US withholding tax, as long as, of course, the requisite US tax form have been submitted and validated properly. So we seek to be the first choice US office REIT offering unit holders the opportunity to invest in a distinctive portfolio of office properties. Our sponsors are Keppel and Core Pacific Advisors. So slide 5 shows some key highlights from our 3Q update that we released last night. So you can see that MPI or net property income was 65.9 million for the 9 months ended September 2023. So this is about 2.6% higher year on year due to better performance from the remaining portfolio. Of course, we sold our 2 small landed assets late last year. So despite the challenging environment, leasing momentum was quite good with about 539,000 square feet or approximately 11.3% of our portfolio NLA leased for the 9 months. So leasing for 3Q itself was about 250,000 square feet, and which is why our committed portfolio occupancy is up 91.4% compared to 90.8% as at the end of second quarter. So our built-in average rental escalation remains about 2.5% throughout the portfolio, and DI or distributable income was 39.2 million for the 9 months. So DI would have been 12% lower year on year compared against the 9-month 2022 adjusted DI of 4.5 million, assuming the first quarter 2022 management base fee were paid 100% in cash rather than units. So the drop is mainly due to, I'll say, the higher financing costs for this year. Aggregate leverage remains quite low at about 9.1% considering the environment, and interest coverage was about 3.3 times. So it should be noted that our debt covenant essentially is consistent with the MAS regulatory limit, which is a maximum aggregate leverage of 50% and a minimum ICR of 1.5 times. So we have ample headroom to the 50% limit, either from the perspective of the ability to take up additional loan or from the perspective to whether any potential fall in valuation. So with that, I will hand it over to Dave.
Great, thanks very much, Andy. We're going to transition this presentation a little bit. Andy has covered for you essentially the update on the financials. What we'd like to do with the rest of the presentation is to help you understand a little bit better who Core is, what we do, how we do it differently, how that differs from maybe our peer set a little bit in terms of what we do and what the results are and why they're a little bit different. I know there's a lot of concern out there about the US office market for good reason. And I know some of that comes from the fact that we've got a couple of competitors that have, underperformed a bit, especially in terms of unit price versus Core. And a lot of you are probably wondering if we're sort of in the same boat or going to be at some point soon. And we don't see that as being the case. So we thought we'd try to put together a presentation that helps you understand some of our strengths and focuses and how we do what we do. So we're going to cover investing in the right locations. We're going to talk a bit about building strong relationships with the right teams. Those are going to be internal teams, external teams, leasing folks, asset management folks, property managers. There's a whole bunch of folks that go into that. Jeff Rader, who's here with me, who is head of asset management for Pacific Oak Capital Advisors, which we outsource to for our asset management function. Andy already mentioned that is one of the co-sponsors for the manager. And so Jeff handles that. He's going to talk about those aspects. And then I'll come back, talk a bit about developing the right sort of tenant base. Then we've got a video from a lady named Candace Campbell, who is our lead, if you will, for design work that we outsource to and work with on most of our properties. She's going to talk about how we design up office properties, whether that be amenities, branding, tenant space, you name it, to create the sorts of places where tenants want to be, where they want to bring their employees into, and hopefully can get their employees back to. So with that, I think we'll move into the presentation. I'm going to take that first point. The first slide here, which will hopefully come up shortly. There we go. Oops. Shows our presence in key growth markets in the US. From inception, when we launched in 2017, Core has invested in types of markets we call key growth markets. What that means in general is going to be markets where you have things like GDP growth, population growth, job growth, wage growth, rent growth, you name it, all kinds of things. They're going to be stronger in these key growth markets than you'd find in the US as a whole, or than you would find in the gateway cities in the US. Gateway cities probably being the cities that most of you who are listening to this or watching this are more familiar with. Places like Los Angeles, San Francisco, Chicago, New York, Boston, Washington, D.C. Historically, people thought of those as the places where innovation is happening, where growth is happening, where the U.S. economy is really built and that sort of a thing. I would tell you that hasn't been true for 10 years, maybe 2 decades at this point, where a lot of that has really transitioned into other types of markets that we call key growth markets. In the case of ours, you can see their locations on the map. You can also see on the right-hand side of the screen that we have a number of other attributes, if you will, for each of our markets. So it's a mixture of things that are called magnet cities that have a magnet, super sunbelt cities, 18-hour cities that have a clock in front of them, supernovas or super strong markets that have sort of the atom symbol, if you will, and then multi-talented producers, which is our Seattle area, which we're on the east side in Bellevue and Redmond. And that is, one of the largest, most vibrant sorts of cities in the United States. If you look on the far right, you'll also see that all but one of our markets fall into what are considered the top 20 U.S. markets to watch for 2023. So we are really in all the types of markets that people are moving to, businesses are moving to, and that are the strongest markets in the U.S. There's a number of others, not just ours. Salt Lake City would be one, Raleigh-Durham in North Carolina, and there are more. But we are in those types of markets and have been since inception. And that's a big piece of why we are as successful as we are. We can move to the next slide. That's going to talk about exodus from the gateway cities. And this will sort of prove out my point. If you can see from this chart, there's a lot of statistics that we talk about, but essentially, the top 4 markets in the United States for losing individuals, so losing people, are New York, San Francisco, Chicago, and San Francisco in that order in terms of largest number of people lost. That's it's not a good thing for the gateway cities. You can see from the chart on the right, though, that the sorts of places people are going are Texas, where you find Houston and Dallas, Atlanta, where we have invested in the past, and still consider that a key growth market we'd like to invest in. Phoenix, another of our target markets. Miami, another of our target markets. Several other markets would make this list if it was something different than the top 10 largest metros in the US. Because a lot of our markets, like Nashville, Denver, are not top 10 largest, but they are some of those that have the most positive demographics. Another thing you'll note on this chart, California lost 352 companies from 2018 to 2021. 207 of those companies moved into states that we invest in. And primarily, they moved into the cities in which we invest in those states as well. There's a lot of income that has left those big markets. $29.1 billion worth of gross income has left California with the people that left that state. Following that, 24.5 billion left New York along with the people. Another 10.5 billion left Illinois, where we find Chicago, along with all those folks as well. So that exodus has been happening. It's been very detrimental to those big cities, very, very positive to the markets we invest. I've got the next slide here. It talks about geographic diversification. This is one where I'm going to start to talk a little bit about the comparisons that you might make between us and a couple of our peers here in Singapore. We all invest in the US. We all invest in very different places. There's a little bit of overlap. However, if you look at the dark blue lines at the top for Washington, Texas, Colorado, Florida, Tennessee, and a very small blue line in California, you'll find that we are investing in states like Washington, Texas, those that I mentioned. Of those states, Washington, Texas, Florida, and Tennessee, and though you're going to find 82% of our portfolios located in those states have a 0% tax rate for personal income taxes. One of the big reasons people have been moving into the markets they move is due to taxes. It's also due to cost of living and a lot of other things, but taxes are a big driver. 82% of our portfolio in states with 0% personal income taxes. When you start to look at where Prime and Manulife are located, you'll see there Manulife's the light blue, and then Prime is the green. Those light blue, if you add them up in states that include Washington, D.C., California, and New Jersey, just those states alone, you'll find 60% of Manulife's portfolio. All of those states have over a 10% personal income tax rate. Prime has about 30% of its portfolio in those very same states. If you look at the bottom of this chart, those highlighted markets, so Virginia, D.C., California, New Jersey would be considered the gateways. Virginia, essentially Northern Virginia, is the sort of surrounds to Washington, D.C., and so is considered D.C. for purposes of leasing an office product. 3% of our portfolio is in gateways, 30+% of Prime, and then Manulife has 60% of its portfolio in gateways. Our markets are outperforming, and that is a big reason, one of the big reasons why our portfolio is outperforming. Jeff is going to talk now a bit about those relationships, which is a big, big reason why our portfolio is outperforming. They say in real estate, location, location, location are the 3 most important things, and that is true, and that's why I just talked about location, location, location. That only applies when you're buying a real estate. After that, it is relationship, 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 and Jeff's going to share about that now.
Yeah, so let's go to the next slide. So we're going to talk a little bit about the importance of relationships. I'm going to tell you a little bit about our asset management team, and then I'll talk about how our asset management team coordinates with the leasing team, property management, and our other teams within the organization, and how we kind of build relationships and create an experience for the tenants. So if we go to the next slide. So as an asset management team, I mean, you would expect that we have extensive experience, that we have decades of experience in the key growth markets across the U.S. We've done billions of dollars of transaction volume, millions of square feet of leasing. But that being said, I think you would expect that from any asset management firm. So what sets us apart? What's different about what we do? Well, because we have decades of experience in these markets, we have a reputation. And I think in US real estate, that's really, really important. Tenant reps that represent tenants in our markets know about Core and Pacifico, that we're deal makers. And, so there's three things about that. One, we build exceptional spec suites, and we'll talk about that later, and you'll see some pictures of the type of space that we build. And they know that, so they bring their tenants to our building because of the type of spaces that we build. Second of all, we pay our broker commissions on time. And you're like, really? That's really a thing? That's really important? But there are landlords in our markets that have bad reputations, and tenant reps want to work with landlords that meet these criteria. And third of all, we have a dedicated legal team that's focused on timely execution of leases. So just having that reputation, having that experience in the marketplace means that we're a step above others. And then there's another piece of it that's somewhat hard to put your finger on, but we know our leasing teams and the top tenant reps in the market on a first name basis. And we don't just talk about work. We know our families, we know our interests. We spend extensive time together. We've been on dinners, we've played golf, we've gone on fishing expeditions. And that deep understanding and relationship means, why does it matter? Well, what that says is with reputation and knowing these individuals on a first name basis, we don't have to advertise our buildings. When these tenant reps have a survey for a 5,000 square foot tenant, 10,000, 20,000 square foot tenant, they're going to take those tenants to a certain number of buildings in the market. These tenants only have a certain amount of time. And what that means is oftentimes we're on that list because we're a preferred location. And so when you see us doing 500,000 square feet of leasing this year, and we're 91% leased, that's part of it, is that we're getting more than our fair share of deals. That's our edge. Our relationship and our reputation assists us. I mean, at the end of the day, the tenant's going to go where they want to go, but we are getting the chance. We are getting the chance to lease space. And that's a big part of the experience, location and reputation. So jumping on from there, and I'm sure there'll be additional questions, I want to talk a little bit about property management. And I want to do this in a way that just compares us to our peer set that Dave talked about. I'll talk about Manulife, first of all. They did go to a third-party management platform, but when you look at the way they did it, and I know the executives from the major firms, the CBREs, the Cushmans, the JLLs of the world, they took a very clinical approach. They created a checklist of 100, 200 items, and then they had these third-party firms fill that out. Then they went to an outside firm to rank those organizations. And at the end of the day, they awarded the assignments on a measured approach, spreading the awards across the US and across their platform. Now that's fine. They probably are more efficient, probably more cost effective, but it's just a clinical approach. If you look at Prime, they consolidated to a national firm, Lincoln, which I would imagine that none of you have ever heard of. Now, that doesn't mean that Lincoln is a bad firm. They're a national firm. They're a reputable firm in the US. And I'm sure there were some synergies and efficiencies of choosing one firm to manage your business. But the downside of that is that Lincoln isn't in every market. So at the end of the day, probably 75% of Prime's assets are very well managed. But there's probably 25% that Lincoln really isn't the top team in that market. So they're being underserved by making that choice. So then you go to us. And how are we different? Well, we know the top teams in the US. You've heard of CBRE, you've heard of Cushman, you've heard of JLL. You may not have heard of Transwestern. They're a regional firm like Lincoln. We haven't actually interviewed Lincoln, but from our perspective, when we go to meet these teams, we say, you are compliant in accounting, finance. We know you can handle the reporting. Those are the things you're good at. You're on the list because you can do those things. But I don't want in the interview to hear about your pitch of who you are, because I already know who you are. What I want to see in the meeting are the property manager that you're actually going to have run my asset. It's going to be their day-to-day. It's going to be the face of core. I want to see your construction manager, because we honestly, that's a key part of our business that we don't really have a lot of time to talk about today. But that person is the key point of if we have a lobby renovation or a spec suite. They're the ones that are working to coordinate the general contractor, order all the materials, and make sure the job is done on time and in budget. So we want to see those individuals. And so when we go to the market and we interview 2 or 3 firms, we choose the firm with the best people. And so, at the end of the day, what does that mean? Well, we have a leasing team that we've hired. We have a property management team that we hired. We know them all on a first name basis. So when a tenant comes to tour an asset, that management team's there. And if we lease to a tenant, the big part about property management is at the end of the day, they're handling the ice cream socials, the blood drives, the experience at the property. And so not only is it getting the tenant in the door, but 1/3 of our deals this last quarter were renewals. And that means our property management teams on the ground were doing their job and creating an experience that led our tenants to stay at our buildings. So it's not just getting them there, it's getting them to stay. So lastly, I'll spend a little bit of time. We talked about Candace Campbell with Nimble, and we're going to show a video of her and how she is our partner in design. But, one of the questions that is probably in the list right now is that, back to the office has been slower in the US, percentage occupancy is a little light. But then how do you win? How are you getting tenants to your space? Well, one of those things is amenities. And we create and craft amenities, and that includes things like a fitness center, a complimentary fitness center, complimentary food options. Sometimes we get cold brew out, on Fridays, a conference and tenant lounge. But again, those amenities are crafted to the individual market, and that's what Candace does in helping us with that. But the other piece, and one of our things that has driven occupancy, is our spec suite program. In the US right now, it takes about 4 to 6 months to build out a tenant space. Coming out of COVID, tenants were really unsure about what their size was, about how much space they needed, and they needed flexibility. So, since inception, we've probably delivered 50 spec suites in any size from 1,500 to 3,000 square feet. And, and tenants like that ready-made space. They like that flexibility. Oftentimes, and Davis talked about this many times, that our leases aren't necessarily 7 or 10 years. A lot of times our leases are 3 to 5 years. And one of the things about these spec suites is we say, look, come in, enjoy our building. If you find that after 6 months, you need to grow from 1,500 to 3,000 square feet, we can do that for you. And we found that in a lot of cases, our spec suites are incubators for growth. And the other thing about our spec suites, and then I'll turn it back over to Dave to talk about our tenant profile, is that the quality of our spec suites. And so we are cost management within core. And so one of the things that we do is we spend a lot of money on the front end building out these spec suites. We make them first generation space, concrete floors, open ceiling, very nice modern kitchenettes. But what we find is that if a tenant leases that for 3 years or 5 years, we often get 7 to 10 years of life out of that suite. So often our suites with minor improvements, maybe changing out the carpet over time, but we get at least a second turn, if not a third turn, on every suite that we build out. And I think that efficiency and that cost effectiveness is also a principle of our fund. So I haven't covered everything. I know you might have a number of questions, but Dave, I'll turn it over to you to talk about our tenant profile.
Super. Let's move on to the next slide or two here. For us, it's actually pretty critical to make sure that we're leasing to the right mix of tenants. So, you're going to find some differences among office landlords. Typically, if you're dealing with landlords who own in what would be, gateway cities, especially if they're in downtowns, whether it's gateways or elsewhere, they're going to have your typical sorts of office users. That's going to be your professional services type firms, law firms, accounting firms, consulting companies. That's going to mean finance and insurance companies. It's going to mean that the typical types of big space users. For us, that's not actually our target group. We obviously will have those in our mix. We own office buildings. They make up a portion of that. But those types of tenants are not going to be our biggest tenants. In fact, we don't have any of those types of companies in our top 10. We probably don't have them in our, I would guess, top 20, 30, 40, or 50. But they're not great tenants at the end of the day. They tend to shrink over time. Everybody thinks this whole thing started with COVID, where everybody started shrinking office space. Law firms have shrunk their office space every time they've ever had a lease renewal, as have accounting firms, as have most of the types of firms that I mentioned, because they try to find more efficient ways to do their business. And in a lot of those cases, including for consulting firms, they make more money when their people are out at somebody else's business taking up their office space rather than sitting in the home office. And so we've always tried to avoid that group. In doing that, what do we focus on? And for us, that's really been trying to find growth tenants. And so we've found, and I think this has really been the case for a very long time, that technology companies tend to be some of the biggest growth companies in the U.S. They certainly brought us out of the financial crisis, will be the ones bringing us out of where we find ourselves today. You can expand that to be the full TAMI acronym: technology, advertising, media, and information. And that makes up a big portion of our portfolio. And that is a group that we really do try to target, along with healthcare, because healthcare is another growing, and this is whether you're in the US or anywhere else in the world. We've got aging populations, we've got all kinds of issues, and healthcare is really becoming a big growth industry and really becoming important to a lot of different economies. So we try to focus on those types as well as other types of growth companies. One of the other distinctions I would say that we have is we have a small tenant focus. We have a lot of small tenants. We're going to be talking a little bit more about that as I get to some of the other slides, but that gives you several different positives. One of those is going to be small tenants don't tend to downsize. If you've got 10 employees and you lose one, your space needs don't change. So if you're in 1, 2, 3, 4,000 square feet, you're not going to try to shed 5% of your space. It doesn't make sense. You're going to continue to operate. So that's a plus. And there also tend to be growth companies. So Jeff talked about that just a moment ago. But sort of flexible leasing for startup type companies, it's not a huge percentage of our portfolio, or even just smaller companies that have big growth plans. We can offer them space, and then we let them grow into our spaces, or we grow with them, if you will, is how we like to look at that. And so we find that to be a really positive way to run a portfolio rather than have a lot of large tenants. The problem with large tenants are multi. One, if they're going to downsize, they're probably going to downsize big. When they do that, they often don't want to live through it, and so they vacate the building. We know our competitors, our peers, have seen that, substantially. They also, tend to be the sorts of folks that will, completely, vacate a building for other reasons because they're getting pitched by a lot of other folks that have major vacancy in buildings, and that's going to happen in markets when the markets tend to get softer. And so they're much more prone to have others that are coming after them to try to pull them out. And finally, it is really hard to lease hundreds of thousands of square feet to a single tenant. So when you get a vacancy, of significant size in the 100,000 square foot plus, those are tough. We call that elephant hunting, and it's not fun to do it. We would much rather be looking for tenants to put into 3, 4, 5, up to maybe 20,000 square feet, and that's the majority of what you find in our portfolio. So We're gonna move on to the next slide and we'll talk about some of these things in a little more detail. Industry diversification. I mentioned we try to focus on TAMI and medical and healthcare tenants there because they're major growth types of tenants. On this slide, what you see, those two together make up about 49% of our portfolio. For our competitors, for our peers, what we've tried to do is look at theirs and just say, you know, based on what you disclose, what do you have for TAMI type tenants, medical and healthcare? And so when we look at that, you know, that's close to 50% for us. For Prime, that looks to be about 26% of their portfolio. And for Manulife, that looks to be about 16% of their portfolio in those major growth categories. There's a whole bunch of other types of tenancy listed here. Pretty much most of it falls into the things that I said: professional services, finance, and insurance for everything that's not TAMI and healthcare. There's some small groups of other things. You know, government, I would say, would be maybe the worst type of tenant that you can have in the U.S. You're talking about leasing with the GSA for the federal government. We've got them in our portfolio too. They fall into a small portion of our other category, but you know, they're not our favorite tenant type because you don't get lease rental growth, and they don't like to spend money on their space, so your space doesn't look great. So we think this really shows you, you know, why our portfolio stands out as different, or one of the big reasons that drive our strength and our occupancy. We'll move to the next slide. We'll talk about another. So you look at size, which I've already talked about, or number of tenants. We've got 400 tenants within our portfolio. Prime, that last listing was 249, Manulife 184. We all have relatively similar size portfolios that are somewhere close to 5 million square feet. But if you look at our top tenant for our portfolio, they make up 3.6% of our cash rental income. For Manulife, that jumps up to 5.7%. For Prime, it jumps to 8.4%. That's a lot less diversification. That's a lot more risk. We can lose our top tenant. It's about 3.6%. For them, it's 5 to 8% of the portfolio. Our top 10 in total are only 24% for our portfolio. Jumps all the way to 33% for Manulife. Jumps to almost 40% for Prime. That's a much more concentration in their portfolios than ours. So we feel really good about that. One other quick math thing we could do with this page if we want to is you could take our total portfolio and divide that 4.8 million square feet by our number of tenants. Do the same for Prime and Manulife. For us, you're going to get to a number that's about 12,000 square feet on average. Our average tenant is going to be typically much lower than that, but we do have some larger tenants that run to, the 50s to the 100,000 square feet. Not a lot, but we've got them in that top 10 list. If you do the same math for Prime, you find their average tenant size about 50% larger, 18,000 square feet or so, which again starts to tell you they've got a lot more large tenants in their portfolio, which they do. And those spaces just become harder to lease when you get the space back. It's a lot easier to lease a number of small spaces than it is even one large one most of the time in most markets, certainly in today's market. If we go to Manulife, you'll find their tenant size on average is about 30,000 square feet, or 2.5 times larger than our average tenant size, which just tells you, again, there's some big concentrations and a few big tenants in that. And for us, 30,000 square feet is technically a large tenant in our portfolio, just to put that in perspective. So, we think that makes a lot of sense. It speaks to some of the security in our portfolio diversification, and one of the reasons we're able to be successful in leasing. We're going to have one more slide here, I think, that's going to talk about some of the comparisons. Again, another way to look at why are we successful in terms of maintaining strong occupancy. Well, you can look at this and say, how much is being spent to maintain your portfolio? So we've pulled from the footnotes of the financial statements for us, for Prime, for Manulife, what we've all said we've spent on capital expenditures, inclusive of tenant improvements to the best we can tell for one of them lists it, one does not. But we think it's the exact same data set for all three. For us, we spent about $97.4 million for the last 3 years. Prime 52.9, Manulife 87.6. We used the last 3 years because that's how long Prime has been around for full year periods, so it's the best we can do for a comparative period. We look at the average assets under management. We've got a description there of how we calculated that. That's again coming from the property footnotes and or balance sheet by just saying, where did we all start? What have we added since then? What have we sold off? Here's the average over that same time frame. That tells you we have spent on average per year, about 2.4% of the assets under management on the portfolio to maintain it, to grow it, to improve it. You do the math for prime, that's about 0.8% per year. You do the math for Manulife, comes out to about 1% per year. So if you want to look at it on a comparative size basis, I mean, it's telling you we're spending more money to make sure that we have buildings that are in optimal condition and or to build out space for tenants. Prime is about 17% larger than we are, and they spent about 84% less on capital than we did over the same 3-year period. Manulife is about 66% larger than we are and spent about 11% less than we did on capital over the same period. Just a couple of different ways to try to look at it, help it make sense to people, that we're spending more money to make sure we're doing things that really need to be done to lease the space. And we'll go to our last slide here. All those things that I just talked about, we believe, contribute to what you see on this chart. On the left, you see 2019 occupancies ranging from 93 and change for us to 95.8 for both Prime and Manulife. You get down to today, we're sitting at 90.8. This is at June. We're actually up a little above 91 this quarter, and down into the 85s for both Prime and Manulife. If we look at what we know are known vacates for us and for them, you could take off a couple of percent for us, and you could probably deduct about 5% for both of them, just to know where we're going to be with what we know we're all getting back. But that holds about the same. We're down a few to, maybe 5 or so. If you take in known vacates, they're down about 10 now to, maybe about 15. Hopefully they've got more leasing coming and later in the year, and hopefully we do as well. But we've held up quite a bit better, and those are a lot of the reasons. Jeff's talked about a lot of the others. We're going to have a video now from Candace Campbell that we've talked about that is going to get into all the design work that we do, how we try to create this functional, livable, great space that tenants want to have to help bring their employees back into the office, how we tie it all together. And she does a great job of doing this for us and presenting about it in words Jeff and I couldn't come up with if we tried. So we're going to turn the video on here, and then we'll come back for questions after that.
So my role is to make the intangible tangible, forming an emotional connection between workplace and its end user, as dynamic and complex and ever-changing as we know that end user to be. And the way that we do this is through a strategic design philosophy that we've coined as branding for the built environment. And when we talk about brand, in this case a property brand, what we're really talking about is a living reputation. How a property meaningfully adapts to connect to its target consumer, a company and its wide range of diverse employees, each with complex needs, formed expectations, and lived experiences that make up their lens for shared decision-making. So when a company walks into a core-owned property, we not only want them to have a formed emotional response, this intangible connection to physical place, we want it to radiate from every aspect of that experience. This is why Core invests in design early and allows for conscious living iteration of its property brands through strategic capital spend. Iteration allows us to respond to user needs creatively and unexpectedly every time, designing for the unique needs of the property and its market dynamics, while always challenging ourselves to push for experience distinction across the portfolio. And there are 3 main pillars in how we achieve this on the capital design side that we'll enter into discussion with today. The first is defining a brand that's built for connection. Every core acquisition goes through a strategic brand development process in which we determine a guiding visual language and design vocabulary that will weave through every aspect of the planned digital marketing and tangible on-site experience. Here at Bel Air Park in Houston, Texas, we utilize a dual color scheme to help diverse medical patients and daily office users orient to their correct destination within this mixed-use setting more seamlessly by use of color to convey a wayfinding cue. Gold stands out to visually orient our medical patients to appropriate parking and drop-off areas so their connection from point of arrival at the street through point of return is a positive one by way of simplifying that wayfinding process of getting from point A to point B. The same is true on the office side and being able to achieve something that streamlines their experience instead of providing a funnel of everyone trying to orient to where to get to the right place. The second pillar that we'll talk about today is smartly programmed move-in ready tenant spaces, or spec suites. Spec suites deliver two unique advantages to its target consumer. The first is speed. Tenants can physically tour or even virtually tour a spec suite in real time and make an informed, immediate decision to lease, which is helpful to companies right now who are still navigating right sizing discussions or their return to work strategy in this hybrid world. The second advantage is innovation. Spec suites deliver a complete vision to the end user. There's no guessing. There's no filling in the blanks or seeing yourself here. The end vision that a user can see, touch, feel, and embrace of their own is really helpful because brands want to connect with a workplace that their teams are going to get excited about. Spec suites allow us to deliver the holistic picture down to even curating the level of finish and furnishing that are going to show up on site. At core, we really strive for above market finish, lighting, and fixture packages that achieve that extra level of detail and design distinction. So when somebody comes to physically tour this versus something else in the marketplace that they might be competitively shopping, ours are going to stand out because they feel like that one step further that somebody can connect with and that they're going to be left with an impression of. Here on the screen, you can see just a small range of the many spec suites that we have going on across the core portfolio this year. To illustrate how we think about spec suites, today we're going to talk about Iron Point Business Park, a 5-building suburban office campus located in Sacramento, California, in which the 1150 building, the one starred on screen, is becoming available at the end of the year for the first time. When we learned the news of this happening, we asked ourselves a series of strategic questions. What do we want to achieve with this building? Do we want to wait for a tenant to backfill in place? Do we want to expand this building to become more amenity forward? Do we want to convert this building to a spec suite building and offer something fresh and dynamic for the campus? In order to answer any of these strategic design questions, we have to begin with discovery. And I'm happy to say by the time that this tenant vacates, we'll already be ready to mobilize and begin demo on this exciting amenity hub and spec suite incubator combination as a renewed anchor and experience driver within this multi-building campus setting. The reason we got here, in order to determine where we were strategically heading, we first had to survey where we've been. In this case, a large tenant building with ancillary underscaled tenant amenities that were lacking design distinction or any form of true user connection. So in determining our design strategy, we begin every project with discovery, which at its core answers this root question, which is, who do we want to become and for whom? Essentially, why do we exist? How are we providing value to the end user? And who is our end user? And to determine this, we survey our local teams, we research the market for both aspirational brands and competitive brands to see how we already fit in, and we find the right mix of design formula to position ourselves to set above and offer something distinctly ours in the marketplace. And we begin to explore contextually how are we going to design something that provides a fresh value to our particular end consumer. And set a visual benchmark for both user experience and brand expression and where those two things will intertwine. Ultimately, for Iron Point, where we landed was that we wanted to achieve a balance of neutrals and warmth, visual calm and concentrated energy, and this idea of open space met with enlivened nooks that are meant for recharging. Once we determine who we want to become and for whom, and have designed our design language, we begin to connect it. And so for this building, we ultimately determined that spec suites that were going to be sub 3,000 square feet was our ultimate sweet spot. And the reason for this is because smaller tenants thrive off the energy and hum of common connection. We were also able to achieve an increase in our amenity footprint by 15%, simply by capturing underutilized building core storage spaces into additional meeting spaces in an enlarged wellness studio that now offers not only more equipment, but a strength building area that's off the window line and provides an indoor-outdoor connection to its end users. Lastly, we connect this design to its leasable space, always leaning into a flexible, diverse finish palette that we combine and contrast to create eclectic spaces that feel hand-selected down to their last detail. In every spec suite at Iron Point, there's a varying level of combination of finishes and lighting and fixtures that provide that level of different in every suite. So touring the entirety of the building, users have something that they can respond and connect to and find their favorite on. And that's the exciting part about design, is that you don't know until you see it most of the time. And so by providing something different, you're creating reason for conversation and reason for connection to occur. Our third and final pillar that we're going to discuss today is common area and amenity spaces that engage and inspire. At core, every capital project that we take on is considered a brand extension, with user experience at the center of our design decision making. Here at Westmore 3 in Denver, Colorado, we recently wrapped up a full building common area and amenity core refresh to transform this tired, once single tenant headquarter building into a hospitality forward hub that is meant especially for shared interaction. On the left, you can get a sense of where we were coming from pre-renovation. Lots of geometry, lots of dated neutrals and sun-faded materials, and an overwhelming but yet underwhelming attention to detail, something that just didn't feel that great to walk into. On the right, you can see where we started to head through render visualization and design exploration. Here we were trying to achieve, let's say, a less is more approach to a high balance of neutrals and calm, paired with brand activation by way of custom signage and art detail that connects your eye up and through the entirety of the building. You can see that W detail, or the brand activation, happening not just here in the lobby, but again at the start of the amenity space and down the corridor to connect users from one place to the next throughout the entirety of the building experience.
Okay, I can't tell from my screen whether this is back on me or not, but I'm going to guess that it is at the moment. So we will go ahead and I think open up for questions at this point.
Yeah, sure. Thanks for the presentation, David and team. Yeah, so let's head right to the questions. So the first one is, US office sector is in a very bad situation. What's your plan if your office valuations fall 20 to 30% in the coming 1 to 2 years?
Well, first of my plan is to hope that my office valuations don't fall 20 to 30% in the coming 1 to 2 years. I think that would be surprising. I know we've got some peers that have had valuations fall by those sorts of levels already, and probably more expectation in the marketplace of more falls, just given what we're seeing in the US, which is ranges of folks saying US office has fallen somewhere between, call it 12 or 13 and 17 or 18% for 2023. That is probably about right. If you're thinking about gateway cities, that's not what we expect to see in our markets, which are quite a bit stronger. So, I think we're hoping to see a revaluation that's going to be certainly much lower than 20 to 30%. But hopefully a revaluation that is not in excess of 10%. We don't know. We have to switch valuers every 2 years. So we're having to move to JLL this year. So we don't really have what their views were last year to rely on to give us some indicator. We do know that cap rates and discount rates are going to go up this year. So there's definitely going to be a revaluation. And we've seen the risk-free rate trend up during the second half of this year. It didn't really at the, in May when we were making decisions about revaluation, even in June, it was about consistent with what it was at the prior year end. And therefore we really didn't expect much to be of any change in valuations if the risk-free rate was the same. Now that we're seeing it trend up, it's going to have an impact. We're going to have to wait and see. But we certainly don't expect to see the kind of range that's shown in that question.
I see. Okay, yeah, the next one is the risk-free 10-year yield has just broke past the 4.9%. Can you explain what are the potential implications on the REIT and what is the steady state 10-year rate management foresees in the near term?
Sure. I mean, I think I just talked a little bit about that. It's going to have an impact on cap and discount rates. It's also going to have an impact for us on interest rates for at least some period of time. The Fed's given a lot of indications about thinking that they're going to remain higher for longer. So far they haven't been very accurate in both of their predictions. So we're going to assume this one's probably not that much different. It's definitely going to be a bit higher than people expected. Hopefully we don't go to the level people did. It doesn't seem like it's as likely the Fed's going to raise rates again. They certainly could. But we're starting to see some cracks in the US, though, as well, that haven't been addressed in Fed comments up to today. And so we are seeing a little bit more weakness, certainly for folks that are on the lower end of the economic scale. There's a lot of pressure. That is getting rougher and rougher as we go forward. So, some of those things, there's some other changes that we're seeing in certain economic factors and areas, which can include used car pricing to various other things that may be weighing in favor of not seeing the rate increase. But over time we expect it to come down. How much? I don't know. If people think rates are going to go back to the incredibly low level that we've had for the last number